Right. Okay. Great. Actually, this is probably my favorite bit of the when dealing with this because I like the sort of it's like what's like the intricate in the way you think about it because initially it's something you might not really think about, but it's actually really interesting the way that the journals work here because it's like I said, really the reason I like it is because conceptually there is a way of looking at it, and conceptually the way I think about it, which I think is quite cheeky, is that when you have two organizations come together, like I say, ultimately they have the same A is equal to C plus L. So if you have a box, if you buy a box for £100 and it's sitting there, I mean, the whole aim, right? And the reason why I like it is because it reminds me of the early days of trying to explain this equation to people as to what profit really is. I mean, what profit is I'm trying to get rid of this box and get more for it. So if I can get rid of this box and get 150 for it, in effect, I've made a profit of 50. So this is the idea. This is all accounting. This is what accounting really is. How do I recognize this increase in the gain in this box to match my new found asset or wealth? And that's what this 50 is. That's the definition of profit because the box is no longer with me. But imagine the box is still with you because all you did was move the box from one room to another room. So I just moved the box from one room into another room. So the box is still with you, but it's recognized at 150. So you're recognizing profit of 150. Doesn't matter what room it is. Think of that room as the room of this. Well, here's the thing. Here I am teaching the other day, saying think about it as thinking of it as in you move the box to your subsidiary. So your subsidiary has a box worth 100, showing 150, and the parent is showing profit in its own C, because remember there are two C's here, so to speak. There's the C of the um, of the parent, so to speak, and there's a C of the non-controlling interest. Um, so the parent is showing this 50 in its own C, but there was a question the other day where it was the subsidiary that sold it to the parent. So it was the the subsidiary showing the profit within its own capital, if you like, as opposed to um, the parent showing the profit. But the key point ultimately here is that we have an increase in, we have an inflation, I think is the right word I should use, an inflation of inventory that we shouldn't. And this makes us look good because we have assets that are increased in value, and we have also which is why, I mean, again, I say I find it interesting because it's everything accounting is about. It's about prudence. It's about why we always recognize inventory at the lower of cost and net realizable value, if you like. Otherwise, it's the reason we don't recognize inventory at its selling price. It's just that whole, it just kind of brings it back home, this very idea of what's going on when we look at inventory measurement. So ultimately, what you've done here is to create inflation. So that's the thinking here. So hopefully you might even see. So my ultimate journal, just from a conceptual point of view, must be to eliminate this inflation. So debit retained earnings with this inflated profit, and credit inventory, because inventory is the asset. Oops, sorry, inventory is the asset that has been inflated. What was I going to say? Inventory, because in the statement of financial, when we merge, you will have inventory, whatever, parent plus subsidiary minus this increase, which I call X. So it really didn't matter whether the inventory was here or here. The issue really is to do with the retained earnings, because that's really what matters. Who has that retained earnings? Where is it sitting? Right. Okay, great. So profit made by members of a group, recognized in the accounts, in terms this must be eliminated from the consolidated accounts. And typically we have this sort of event happening with inventory and also non-current assets, the shift from one parent. I mean, it really doesn't matter. It's the key point is you have assets shifting from one person to another, and one person is selling it and claiming this profit, but no such thing. So we need to get it back to its its fair, its normal value. And I've written here we need to eliminate this so-called profit that has not been realized outside the group, i.e. by selling it to a third, party. Because that's what profit is. It has to be sold to a third party. So current accounts gone, but when you have goods that's still held by the group, that unrealized profit must be cancelled. And I highlight here inventory must be included at the cost, right? So kind of IES2, kind of thinking again, original cost of the entity and then sold. Right, so what am I saying here? Imagine, yes, this is me just, now I'm just walking through the journals so you can see exactly what's taking place here. Imagine a business has two departments, and the business buys inventory. I'm just doing it, but just the journal so you can see what's going on. So the business bought you debit purchases, credit. So this is the first business. Doesn't really matter. I want to say parent, but it could have been the subsidiary. The key point is that someone bought it, and this is the real third party. Debit purchases, 1,000. Credit external trade payable. And then what happened? We sold it to the guys in the next room for 1,500. So what do we record? We debit internal, if you like, trade receivable, current account, right? And we credit revenue. Say we're the parent. This is an internal trade, internal revenue trade. So when we come to do consolidated statements of profit and loss, you'll see why we eliminate revenue, internal revenue trades, because they're not real. This thing is just not real. This is ridiculous, right? So that's the first issue here. We sold it to the guys for 1,500. Now, I've written here the parent company will now show profits sitting in their retained earnings. I'm assuming the parent is selling it, by the way, of £500. But I highlight here that the goods have not left the building, which is why they're referred to. So the profits, that 500 really is referred to as unrealized. It's sitting in the inventory of the subsidiary. The buying company, though, this is what they did. In this case, the subsidiary did this. They bought purchases, internal credit purchases, if you like, credit internal trade payable. This is not an external creditor, which is why you can see us eliminating this. I put this in green because we will eliminate this when we come to the next chapter. And you can see we have so far in the previous video eliminated the current accounts. And this is the current account. That's how your current account arose. Yes? Right. So I'm just kind of taking you through to the last bit of this. If the goods have not left the building, those are my cost of sales. As you can imagine, here, what do I have? This is my subsidiary. Yes, you bought goods, 1,500. The goods have not left, so what do? We credit cost of sales, 1,500, and we debit closing inventory, don't we, with 1,500. That's the double entry for dealing with we're dealing with these things at the year end, isn't it? If you like, I mean, that's what, yeah, you know that, right? So what we now have here is a case of goods we bought for 1,000 now sitting in inventory at 1,500. I emphasize again an inflation of £500. This needs to be eliminated. So what's the nil elimination process? Debit retained earnings, in this case in the parent, which typically will come out in working 5, and credit the closing inventory, which is on the statement of financial position. Straight on it, if you like, right? And yeah, so when one group sells, yeah, where are we? I think, yes. So this is just really the layout, just highlighting the key points. So when one group sells goods to another, a number of adjustments need to be made. So typically we'll see a question, but what the idea is determine the value of closing inventory, and they'll talk about this question of a markup and a margin. The key point here is we need to determine who the seller is. That's the first thing. And we need to also, what we also need to do is to then work out our problem is with the goods that are left, right? What goods are left? And whatever goods are left, we need to find out what that unrealized profit is on those goods. Right. So let's do the example quickly in this video because that makes sense as opposed to trying to make another video purely on that. It says let's look at TYU. Let's look at TYU 6. So I'm just gonna go there very quickly and focus in on just this unrealized profit bit. Yes. So what do I have here? So it says here that I'm just gonna make this a. You can see here it says the safety. Is it shifting? Safety transferred goods. So this time the subsidiary sold goods. It doesn't really matter for the process of teaching it. A transfer price of 18,000. So it sold it for 18,000 at a markup of 50%. So the goods originally cost, if you like, if this is technically 150%, and then we have 100%, if you like, as the cost, right? 18,000 divided by 1.5. So the goods originally cost 12,000. So they bought the goods for 12,000 and they sold it on for 150,000. So we're told that 2/3 of those goods still remain at the year end. So what's the issue here? We have goods worth, well, 2/3 of these goods are still with us. So technically, really, here's the issue, really, fundamentally, there's a number of ways of thinking about it. I really don't mind how you think about it. The key point is if I find 2/3 of the goods that to think about it, the key point here is IAS 2 wants me to recognize this at its original cost. So all I'm trying to find is what's the unrealized profit. So I can take 2/3. Let me take 2/3, 2 divided by 3, and let me multiply that by 12,000. So what I'm trying to tell you is that the stock, I bought the goods for 12,000. 2/3 are still left. This is equal to 8,000. This should be recognized. The stock that's left should be recognized at 8,000 fundamentally, right? But what you did was to sell it for 18,000, and so therefore, if I was to find 2/3 times 18,000, you will have 12,000. So 2/3. So currently the stock is being 2/3 of 18,000. Currently the stock is being recognized at 12,000. But really, if you like, in terms of the cost, right? Because that's 2/3, and the parent bought it for 18, so they still have 2/3 of it left. So they're currently recognizing it at 12 when it should really be recognized at 8. So therefore, the unrealized profit, the inflation is 4. You could have just done it by subtracting these two, and that's the profit, and then whatever profit is unrealized is, if you like, 2/3 times 6,000. That still gives you 4,000. So you just have to, as long as you conceptually understand that we have inflation here, the question is what's still left, what stock is still left in our warehouse, and 2/3 of it is left. Therefore 2/3 of this profit is still, is if you like, unrealized. So the question is, we have calculated the 4,000. We now need to get rid of it. So we need to ask the question, where is it? Who's got this stock? We know that 4 has to come off inventory. So we know that we're going to add 90 plus 20, and we're going to take off 4 because this is inflated. We have inventory sitting in here at 12 when it shouldn't be. It should be 8. So we're going to take off 4. Then the question is, where does the other side go? And because it is the subsidiary who was sold at this time, it will come off the retained earnings. So when we do working to, it will come off working to sort of at reporting. It's because it's in here, isn't it? It's in there, so it has to come out of there, right? If it was the parent who had sold it, it would come out of this sort of, well, when we do working 5, everything we're doing, it'll come out of there. So it'll come out of here technically if it was the parent who had sold it, but it was a subsidiary who sold it, so it would come out of here. And that's kind of the thinking behind this, right? So that's it. That's the double entry. The double entry is take it out of inventory and also take it out of retained earnings. Cool, that's been 15 minutes, pretty long video there. And that's how we deal with these perps, or these unrealized profits. Cool, great stuff. See you in the next video.